Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we are going over my monthly update for my portfolio. So right here is the chart that I update every single month. This is the Excel formula that I have that pulls up the monthly updates for my annual dividend income, my monthly dividend income, my portfolio value, and my monthly YouTube income. And these are all the companies that I own right here on the left column in column A, the 24 companies that I own. And this is what they pay me on an annual basis. So Broadcom, $26, $34 Realty Income, you get the point. And what I do is I add those up based off the number of shares that I own and what they pay me on a quarterly or monthly basis, and I add them up into a yearly basis. So what we're going to do, go ahead and take a mental snapshot of annual dividend income right here and monthly dividend income, and I'm going to give you the updates on these charts in 3, 2, 1. And there you go. There is the monthly update for the annual dividend income and the monthly dividend income. We increased month over month on a yearly basis from $291 to $315. So a steady increase there, and I know February is just going to be even a bigger jump up as we go into March. And then on a monthly dividend income basis, I know that usually the big months like December are usually where we get the most of our payments. And I'm sure once we get to March, I believe that should be a new record, somewhere probably around $40, maybe even a little bit higher. But $26, very high. I'm very happy with that. That's pretty much a dollar every day. The portfolio is getting to the point now where the dividends alone, you can see from this number, is almost creating a dollar of income every single day. Every single night that I hit the pillow, I'm going to create a dollar worth of income. Now what we're going to do is we're going to show my portfolio value and my monthly YouTube income. So once again, go ahead and take a mental snapshot. We had my portfolio value at $8,800 and some change at the end of January, and my monthly YouTube income, I created $336 throughout this channel through referrals and YouTube ads and stuff like that. And so go ahead and take a mental picture, and you can see the update in 3, 2, 1. And there you go. There is the update for my portfolio value and my monthly YouTube income. The portfolio did go up in value about $400 or so, and then my YouTube income stayed pretty much flat from the previous month, which usually about $350 is about average, as you can probably tell by now. So $343, I'm definitely proud of that. And $103 came from monthly YouTube ads, which January is usually a slow month. And now my new posting schedule, usually only post about twice a week. This is one of the few times I actually post 3 times a week. And the rest of that came from the referrals. And this is all my activity feed for the month of January. Let's go back to the beginning. We had my weekly deposit of $100. We had a lot of buys. We had dividends. We had lots of referrals for January. And the reason is because of that massive promotion. We had steady deposits, steady referrals, steady dividends, and that's what led to that incredible increase in share price from my portfolio. And the reason that we had so many referrals is because of this $30 promotion that M1 Finance just announced. We had 81 people sign up so far, and this is absolutely crushing the goals that I set for 2021, including the amount of people that I wanted to get signed up. We are already at 81, and now that M1 Finance is extending this promotion, you can now get $30 for getting signed up through the end of the month for February. So if you want to get signed up, it's not too late. You can download this link. It is down below in the description right here. Download this link, deposit $100, and get a free $30 just for getting signed up. But if you want to go ahead and see my portfolio, we'll go ahead and get into it because every month I like to go over all the changes that I've made and just go one by one with the companies that I have. So if you're a new subscriber, if you want to just see any of the updates that I have to make, we're going to go through them one by one. And if you want to follow along, you can have this link that is down below in the description. So let's go ahead and check into my number one investment, Broadcom. It is currently targeted at 9% of my portfolio. We're up $279.42 on it, about a 95% money weighted return, so massive gains there. And this company continues to impress me. I remember buying this stock when it was in the low 200s and thinking, wow, it is absolutely a steal. And even at these prices today, I have not lowered my target percentage yet. If it gets up towards the 500 range, I might lower my target a percentage or two. But right now, I still think it has an incredible value. That new percentage dividend yield is actually not updated. They raised that dividend about 10% just the other day. It went from $3.25 up to $3.60. A massive increase there, over a 10% raise. And it's companies like this that continue to innovate. They have a competitive advantage. They have an incredible amount of patents and products that cannot be copycatted by a lot of companies. And basically, they're just in a high growth category. They're in a high growth space. This is the type of stock that I could see myself owning for the next decade, for the next 2 decades. And when a company like Broadcom, that's a semiconductor company, has some of the most important customers on planet Earth that are not going away, that continue to increase their backlog of orders, which are now in the tens of billions of dollars, Broadcom just continues to set the pace for the market at continually growing its dividend and its share price at massive levels. And this is why I continue to hold this stock as my number one investment. And so for my number two investment, we have Realty Income, which goes along with my number three. They're pretty much the same business model, the same strategy. They're almost identical, just a little bit of different companies. But at 7% and at 8%, we have Realty Income and WP Carey. One is about a 4.5% yielding stock, Realty Income. It's the only one in my portfolio that pays monthly and raises quarterly. So you're going to get a minimum of 4 dividend raises a year, sometimes even more than that. And in my opinion, Realty Income right now is trading at an absolute steal. I've been buying these real estate companies like madness. You guys have been hearing me talk about this for months and months and months and months and months now. All the way back to the middle of 2020, I've been talking about Realty Income and WP Carey and why these companies are incredible purchases right now. These companies have incredible amount of cash flows, extremely high yields, which is very rare in this market, but they also offer a lot of upside opportunity. Basically, it's very simple. These real estate investment trusts, what they do is they buy properties, they lease it out, they get monthly cash flows from those, the property goes up in value, and then they pay out most of their profits back to shareholders. So you, the shareholder, the owner of the company, get 90% of the profits paid out every single year to you. And as their properties go up in value, and as they continue to raise prices on their clients and buy more properties, the income and the profits of these companies continue to go up every single year. Even throughout these recessions, they have handled things just fine. And that's why these two companies continue to maintain about 15% of my portfolio, just these two companies alone. And I've even considered bumping them up even more. Yeah, I know. So Visa. Visa is my number 4 investment. We currently are up 20.2% on the company on a money-weighted return, which is about $52.20. And Visa is one of the few companies in my portfolio where I don't care about the yield. The yield is horrible. I hardly get any cash flow from this company. What do I even make? Let's check. Right now, on a yearly basis, I make $3.50. So the dividend that I get from this company is little to none, but the opportunity for share price gains in the long run over the next decade, in my opinion, is going to be massive. While they are extremely high priced now, I think between the dividend raises, the incredible amount of share pre-purchases, and then the 10% plus revenue growth that this company is still experiencing, even throughout the recession and heading into 2021 and 2022, I think that this company will continue to have massive amounts of cash flows like it's done for the past decade. And I just love the business model. I love them as a consumer. I love them as an investor. And the business model of Visa is one that I think is going to be very sustainable over the next 10 years. And that's why I have it at one of my highest target percentage in my portfolio. And I will continue to be buying that stock throughout 2021. JP Morgan Chase. This was one of my bigger buys of 2020. I steadily, actually let's go back here. You see this chart? You see how it's a steady uptrend of higher, 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 higher. I just kept on buying the stock like crazy. And the reason being is that if you look at the year chart for JP Morgan, it looks pretty nice. I started buying it in April around the $90 a share mark, right around here. And as it continually went up, I bought like crazy in the $90 and $100 a share range. And then ever since then, in the last couple of months, it's just skyrocketed in price. It went from about $100 in share to $138, $140 just in the last month or two. And the reason is because this company was severely undervalued throughout the pandemic. And even at these levels, even at 140, I still think it's a pretty good buy. It offers some great yield, has a lot of buybacks, has a lot of dividends. The cash flows, once again, from JP Morgan is massive. This company, of the bigger banks out there, when you're thinking about JP Morgan Chase, Wells Fargo, Bank of America, the big dogs, the mega banks like JP Morgan Chase, in my opinion, is the most innovative, and in my opinion, will probably be around a lot longer than any of those other big names like I named out there, especially Wells Fargo. But JP Morgan Chase is the one few of the financials company that I actually own in my portfolio, and I intend on owning that one for probably a pretty long time. Oh, by the way, we're up 92.38% on a money-weighted return, or that works out to be about $152 worth of gains. 3M is a company, once again, speaking of stocks that I was buying like crazy in 2020, we're up 26% on it, $54 worth of gains, and most of that have come just from the last couple of weeks. In the last year, I've been buying this stock steadily. As it slowly trended up and started to recover from the pandemic, I was buying the stock like crazy in the 150s, the 160s, and now it's starting to get up towards the 180s, and I think it has a lot more room to run. Back in 2017 and 2018, it got way ahead of itself on share price and multiples. I think that this company, as they continue to raise their dividend, which by the way, they just raised their dividend last week, once again, another small psychological raise of a penny just to make shareholders happy, but they've kept that dividend streak. I believe it's 63 years in a row now after this raise that they just announced last week. They offer an incredible yield of well over 3%, and as this company continued to recover from the pandemic, as it continues to produce its 60,000 products to its customers, they will continue to find ways to be profitable as they restructure their business and reorganize their revenues in a way that makes more sense to shareholders. Even though they've had some struggles in the last 2 or 3 years, the massive amounts of profits and free cash flow that this company produces, it's breathtaking. It's incredible. So even throughout headwinds, this company continues to impress me, and I'll continue to have this company at massive amounts of target weighting in my portfolio. That's why I have it one of my largest holdings. That's why it's targeted at 5%, and I definitely will probably be holding that all throughout 2021. It will probably either be staying the same or increases. I doubt it will be going down anytime soon. Southern Company. Southern Company is the only utility stock that I currently own in my portfolio. It's once again also at 5%. We're up 21% on it, or about $55 worth of gains. And Southern Company is very boring, very basic. And the way I look at it, utility stocks, while they're not very fun, they're not very good for a young person like myself, they offer some pretty good safety in the sense that pretty much no matter what, this company is going to be able to maintain its revenue and profits because they're government regulated. They have contracts that are sometimes decades out into the future, and the Southern Company, as they continue to provide natural gas and electricity to its customers, it will slowly raise revenues over time. It will raise its prices and it will increase revenues as its customers pay more for its utilities, and basically as a shareholder, you're going to be able to get a massive yield of over 4% just to own the company. So while the share price is pretty boring, it will stay pretty much flat over the next couple of years. I don't expect any type of massive gains. You'll get steady cash flows that are growing every single year at over a 4% dividend yield. So Southern Company, one I'll probably be holding all throughout of 2021. Pepsi is a stock that I never intend to sell. I'm never selling Pepsi. I'm up 7% on it, about $17 worth of gains, and Pepsi, luckily for me, has stayed low. All these stocks have been flying high, hitting new valuations at rocket multiples. And when we look at Pepsi, it's pretty much just stayed flat. When we look at the year chart, it's pretty much went nowhere. And as a dividend investor, especially for a company that raises revenues and profits like Pepsi does, its products continue to find new ways to make consumers pay more for their products and buy them more frequently. When we look at a company like Pepsi, this is exactly what I want to see. I do not want to see this company get to 150, 160, $170 a share. I want it to stay down as low as it possibly can because I'm a dividend investor. I'm a dividend growth investor. I want this stock to stay low. And they have another dividend raise coming up in June of 2021 and a couple months from now. And as we get closer to that dividend raise, that just offers a better yield for investors. Right now, it's currently yielding about 3%. And Pepsi, between its massive array of products, between Pepsi and Gatorade and Cheetos and Fritos and Doritos and Propel and lots of other brands out there, Pepsi is a stock that I continue to buy and I will continue to own probably until the day that I die. Because basically the way I look at it, if people are always going to need something to eat, if people are always going to need something to drink, Pepsi is going to be there to offer those products. Procter Gamble is one that I just increased my position in, this little spike up right here. And basically this is the company that makes products that you take for granted every single month. This company produces basic things like shampoos and deodorants, and it's been around for hundreds of years and continues to raise that dividend every single year, including throughout the pandemic in 2020, and they're due to raise it again here in 2021, here in about a month or two. So Procter & Gamble, one I'm betting on there, also probably a lifetime stock. I talk about my forever stocks, and I have about 9 or 10 of them, and Pepsi and Procter & Gamble especially make up 2 of those. And speaking which, we have 2 more coming up. Johnson & Johnson, also a forever stock. We're up 24% on it, about $50 worth of gains. Johnson & Johnson, the only healthcare company that I own, because it is pretty much like owning a healthcare ETF. All factors of healthcare like Listerine mouthwash and basic band-aids to all the way high up surgical tech equipment and pharmaceutical companies, Johnson & Johnson owns it all. Anything that has to do with healthcare, taking care of humans from a healthcare perspective, Johnson & Johnson has its footprint in it. While they continue to have a pretty steady yield, they grow that dividend payment every single year. Once again, also raised it in 2020, looking to raise it in 2021. Johnson & Johnson is one of the best companies in the entire stock market. I will stand by that 100%. Because over time, not only will they increase that dividend payment, but you'll be looking at steady share price gains Also, another one that I'll be holding till the day that I probably die. Kimberly-Clark. This is a company that just raised its dividend, and I just increased my position in it just the other day. Kimberly-Clark produces all the paper products for your household, like paper towels and napkins and toilet paper and lots of things like that. Basically, it's a boring company that produces massive amounts of cash flows because people don't second guess buying toilet paper. If you have a job, if you don't have a job, you're going to buy toilet paper. If you have a job, if you don't have a job, you're probably still going to buy napkins. You're probably still going to buy paper towels for your household. And if that's the case, guess who's selling them to you? You're looking at them, Kimberly-Clark. And while it takes them pennies on the dollar to make those products, they then turn around and sell it for some massive margins. So Kimberly-Clark is one that just raised its dividend from $1.07 up to $1.14. So that's about a 5 or 6% raise. And as it continues to raise that dividend, I think that Kimberly-Clark is at an absolute steal right now. It has one of the lowest PE ratios of all my stocks, and while I was trading just at $160 the other day, right now it's trading at $130, and it now has a dividend rate, so it's getting a higher yield than it was the other day. So now it has a massive yield, a very low multiple. I increased my position in Kimberly-Clark, and I'm considering even increasing it again because I think right now Kimberly-Clark is a steal. Next up, we have another company that I did just raise my position in it just this past week. We are down 8% on it, or about $22. It is the most recent, most new stock in my portfolio. Just a couple months ago, we added Lockheed Martin. And right now, Lockheed is an absolute steal, just like Kimberly-Clark. These are some of the stocks that I've been buying extremely heavy over the last couple of weeks. And Lockheed Martin produces all the aircraft for the military, just about all of them anyway. I think it's about 70% of all aircraft products that are in the Air Force are produced by Lockheed Martin. They pretty much have a monopoly on our United States military, and they have some other contractors as well. And this company has over $150 billion worth of backlog. I'm going to say it again just because of how crazy it is. This company has a backlog order of over $150 billion with a B. So when you look at that and the fact that this company has raised its dividend, raised its revenue, raised its profits every single year, pretty much nonstop for the last couple of decades, I'm going to bet that this company is going to continue to be successful. Well, it's hard to understand a lot of the products that they offer because they're so in-depth, they're so intricate. When you look at this company that sells at absolute rock bottom steals like it does right now at $3.30, this company is being valued at $440 a share at the beginning of the pandemic. But this company has increased its revenues and profits since then. So I asked myself, okay, if it traded at $440 back at the beginning of 2020, since then it is now more profitable, has more gross revenues, more backlogs. In that time, why is it trading $100 plus cheaper? Doesn't make a whole lot of sense to me. So right now the PE ratio is low, the dividend yield is high. They just raised that dividend payment almost 10% at the end of 2020, and guess what? They're due to raise it again here in 2021. So when we look at Lockheed Martin, it's a company that I'm very, very bullish on, and I think my returns in 2021 and 2022 for Lockheed Martin are probably going to be quite nice. I think it's going to be very impressive with this company. So I'm picking up shares now at rock bottom prices while I still can. Next up, we have a company, once again, a forever stock, and I'm really wanting to bump this up in my portfolio. Don't be surprised in February, March, especially if we can get any type of downwards movement in the share price, if I can get this company higher up in my portfolio. This is just one of those stocks that you pretty much have to buy at all prices because it's always at a high multiple. It's always flying high pretty much at all times that we're not in a recession because it is a little bit cyclical, but between the massive dividend growth and the massive share price growth, this company is always producing massive amounts of profits because it really only has one competitor, and that's Lowe's. Home Depot and Lowe's sell virtually all home improvement products. There's a few small competitors out there, but the big dogs like Amazon cannot compete with its home front. This is a store that sells huge products. It's hard to get competitors into the space. It's a high barrier to entry model, and the competitive advantage that Home Depot has in this space, in my opinion, will continue to create massive gains for shareholders, and this is why I'm going to probably be holding this company for life. This company could go to $500 a share tomorrow, and I probably wouldn't sell a share. I might lower my target percentage, but if it went to $500 a share tomorrow, I'm not selling it. Home Depot is a company that I absolutely love and intend on holding for a long, long time. McDonald's, I've talked about this a lot, and McDonald's is a company that, in my opinion, It's not a fast food company. It's a real estate company that sells fast food. McDonald's continues to create more restaurants, raise those revenues through the form of rent raises for its tenants or its franchisees. It continues to find ways to increase revenues and profits, even as consumer taste buds change. As we get more and further away from fast food and sugary drinks and things like that, McDonald's has found a way to increase that share price through the form of dividend payments and share repurchases and growing profits. McDonald's is a company that I love. I intend on holding it for a very long time, and even at $211 a share, I'm buying it like crazy. But if it were to go under 200, if it were to go back into the high 100s, 180s, 190s, I would definitely be buying this company a lot heavier. But McDonald's is one that I like, and I don't intend on selling anytime soon. Speaking of one that's went down a lot recently and that I don't intend on selling anytime soon, Coca Cola is starting to run into some pressure, and this right now, in my opinion, is a buying opportunity. While they are running into some struggles and they do have some headwinds to face in the coming years, I think that Coca Cola can definitely bounce back. While right now it's trading at $49 a share, it offers one of the highest yielding stocks in the stock market for a dividend payer like Coca Cola. It's been raising that dividend for over half of a century. Over 50 years straight, this company has continued to raise dividends, and it is due for another dividend raise, I believe, next week. So it'll probably raise that dividend probably a penny or something like that. But in the meantime, it's got to raise revenues, it's got to increase its cash flows so it can get a hold of this new economic situation that we have going on. But if Coca-Cola is able to maintain and bounce back from these levels, I think that right now you're probably buying it for dirt cheap prices. Like I said, at the beginning of the pandemic in 2020, it was trading for $60 a share. And today you can buy it for $49. $11 cheaper. That's about a 20% discount from its all-time high. So Coca-Cola at a massive discount, massive yield, due for another dividend raise. It's a brand that everybody knows, and that's one I'm going to be buying heavily going into 2021 because I'm betting on a bounce back. One that I've lowered my target percentage on quite a bit. I've never sold a share, but I did lower my target percentage on it because I originally bought this company in the $100 a share range. I own it at an average share price at $133, but right now it is trading in the 190s. So I bought a lot of shares early before this massive run-up happened, and I continue to holding my shares. Now, I'm not as attracted at buying this company in the 200 range. It's not a bad buy, but there's just better places to put my money. So if this company can go back down, hopefully we can face some headwinds for Caterpillar to make it go back down to the 180s, the 170s, the 160s. Right now, I am continuing to holding my shares, and while it's not the best buy right now, I am happy with the share price that I own at. Because owning this at 190 is okay, but owning it at 133 at these levels is an incredible price. So I will continue to hold Caterpillar probably going into 2021, but I probably won't be buying it very heavy throughout 2021. And NextEra Energy Partners is the only energy company that I own. NextEra Energy is just one that is basically very forward-looking. This company has had massive run-up in 2021. I did just lower my position in it because of the massive increase in price, but this company is one that I'll probably be holding for a while as renewable energies become more and more popular. Store Capital, I pretty much won't go over this one. Pretty much the same thing as WP Carey and Realty Income. It's a real estate investment trust that I keep in my portfolio. They have an interesting business model that is a little bit different than my other REITs, but pretty much it's the same thing. Real estate, they're going to buy properties, receive cash flows, properties are going to go up in value, they're going to pay you out as shareholders, and then they're going to buy more properties so that way you as an investor can have more profits. Altria is one that I just made a video about, and Altria basically they're having some struggles. This is one of my few risky plays. This is one of my turnaround plays, and this has an extremely high 8+% dividend yield, and as this company continues to face headwinds throughout the features of people smoking less and tobacco product completely revamping the way that this company does business, its legacy business of smoking has been facing some recent troubles, and people are quitting smoking in masses. And this is why a company like Altria has continued to trend down. They have had some troubles, they have made some bad management decisions, but I'm betting on a bounce back. I'm betting that this company will continue to maintain and raise that dividend slowly over time. And in the meantime, it's so high, the dividend yield is so high, that even if the share price goes nowhere, even if 10 years from now this company still has a $40 share price, it won't really matter much because the dividend yield is so high that it pretty much makes up for all share price appreciation that you could possibly need. So Altria, one I'm betting on is a turnaround play. Very high risky stock there, but it's one that I'm going to be holding throughout 2021, very likely. Cisco is one that has faced a lot of troubles and has been hit much harder in 2020 and 2021 than I thought it would. But Cisco, an incredible business model that delivers all its food products towards cafeterias and restaurants and fast food chains and stuff like that. Cisco is one that has had a lot of share price appreciation, has bounced back very heavily, and did pause on that dividend raise, but I think they'll probably be raising it very soon going into 2021. And I think that as this company continues to bounce back and once the pandemic fully gets behind us and the coronavirus is gone, I think that this company will get back to its all-time highs. Cisco is one that I'll probably intend on holding throughout most of 2021. And if we go to the bottom here, one of the last few, Starbucks is one that I just lowered my target percentage on. I love Starbucks. I love the company. I don't want to sell it, but I am lowering my target percentage because once we're in the triple digits, this company is starting to get a little bit rich. It's trading at multiples that are PE ratio right now, I believe in the 30s. Don't listen to One Finance. I don't know why it shows that. That's wrong. I believe it has a PE ratio. I think it's like 32 last time I checked. So pretty rich. It doesn't have a very good yield, but for me as a dividend growth investor, right now it's trading in the hundreds, but I do own it at 84, which is at a lot better share price than what it's trading at right now. So right now I'm just going to hold my shares, see where it takes me. Hopefully it goes down. If it keeps on going up, it's not one that I'd want to part with, but right now it's trading very rich, and there are better places to put my money. Verizon, I won't go over this one. I just made an entire video about it. Go check out the last video. Verizon had some troubles, but it still has its massive cash flows, massive dividend payments. It's one that I'm probably going to hold all throughout 2021. It's a very boring telecommunications stock. Waste management, basically the way I look at it, if you're going to make trash, waste management is going to clean it up. It has a share price that is just a couple dollars higher, but basically I want this company down because it has a dividend yield that's pretty unimpressive, but they did just raise that dividend from 0.545 to 0.575. So they did just raise that dividend about 2 or 3%, and as this company continues to get further along, I think that this company will hopefully stay down. I hope that the extended multiple range goes down, and I hope this company even gets back to the double digits. Because if this could go under $100 a share, this could get to 90, 95, I would be a big buyer in this company because it is extremely defensive, because trash, it's always going to be around. It doesn't matter what the economy is doing, trash is always going to be there, and someone's always going to need to clean it up. And if that's the case, waste management is going to get paid to do so, and you as a shareholder, you're entitled to those profits. And last but not least, we have a 1% targeted weighting percentage in my portfolio. Honeywell, massive run up in 2020. I haven't sold my shares yet. I'm continuing to hold out. And basically the way I look at it, while it has a very unimpressive yield of under 2%, I've had a lot of gains in the stock. It's a company that I don't want to sell. It's kind of like the little brother to 3M is the way I look at it. While 3M is really mature with 60,000 products and has been around for decades and decades and decades, Honeywell is the new kid on the block that is a big conglomerate like 3M is, but they have a lot of opportunities with quantum computing and a lot of products that they already been selling for the last couple of decades. But as this company continues to raise its dividend at a pretty incredible pace and its share price continues to trend up, it's not a company that I'm too excited about buying in the 200s right now, maybe in the future. I am going to continue to hold my shares because there is still a lot of opportunity left in this company. And while it is a little bit rich, if it goes back down, I'll definitely be a big buyer again. But those are the 24 companies that I own, guys. Let me know if you have any questions down below. Like I said, if you want to get signed up with M1 Finance, 81 people have signed up. And the reason that we've had so many people sign up is because they love the company, they love the brokerage, and you get $30 for getting signed up and depositing $100. So if you want to get that $30, if you want to follow on with me, subscribe, download M1 Finance using my link, and I'll catch you guys next time.